Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, and welcome to the first Through the Noise podcast of 2023. Before we start, I would like to wish you all a happy new year from everybody within Standard Chartered's CIO office. Also, just a reminder that we're holding our annual investment conference on Wednesday, the 11th of January. Not only will the CIO team share more details on the investment outlook for 2023, but we're also honored to have Mark Carney, former Bank of Canada and Bank of England governor, joining us. Steve will be hosting a fireside chat with Mark on topics such as economic policy outlook, cryptocurrency developments, and climate change transition. If you would like to join us at the conference, please go to www.sc.com/GMO to register. The link is also in the podcast description for your convenience. Okay, with that out of the way, let's move on to the meat of what we want to discuss today. We released our 2023 outlook in mid-December, and what we want to do today is to see how the past 3 weeks are fitting into our view of the world. To do this, I'm delighted to have with me Mr. Steve Brice, our Global Chief Investment Officer. Steve and I will discuss the outlook of U.S. government bond yields, the U.S. dollar, whether we should sell into the rally for China/Hong Kong equities, and which sectors we would be adding to today. So Steve, thank you so much for joining us today. Maybe let's start with a quick overview of economic and policy developments over the past 3 weeks.
Thanks, Michelle, and Happy New Year to all our listeners. We certainly hope and believe that 2023 will be a much better year for investors, although we are worried about the growth outlook, particularly in the West, of course. I guess most of the economic developments we've seen over the past 3 weeks are pretty much in line with expectations. So if we look at the latest business confidence data out of both the US and Europe, for instance, they continue to highlight the downside risks to growth in 2023. So if we look at the US manufacturing business confidence indicator, that's pointed towards the second month in a row of contraction in underlying activity. And if we look at the forward-looking indicators such as the new orders index, that was in contraction territory for the fifth month in a row. So clearly it's a challenging environment from an economic perspective there. Similar data out of Europe, also contractionary, although actually it did improve slightly from the lows that we saw in Q3. On the policy front, of course, the Fed has been central to what we've been talking about for the past 12 months. And so it's likely that's going to remain the case in the immediate future, at least. And the minutes from the latest FOMC meeting in December suggest that the Fed is unlikely to pause in its tightening of monetary policy settings, at least for the next few months, until they see either a sharp deterioration in overall economic activity, a deterioration in the job market, or a sustained decline in inflation. And if we look at the second area, the job market, we've seen some significant data out this week. It all points to a still strong labour market, and given inflation is still elevated, although it does look like it's peaked, that means I think the Fed is likely to continue hiking rates by more than is currently priced by markets. So against this backdrop, I guess we remain comfortable with our playing it safe theme, which at the highest level really argues for us being overweight, high-quality investment-grade corporate bonds relative to equities.
Right, so that's definitely a dynamic start of 2023. Perhaps let's pick up on the bond theme to start with. With the Fed sounding hawkish, do you think now is a good time to be adding to bonds?
Yeah, so in our 2023 outlook, which we published in mid-December, we argued that Fed hawkishness would likely create upward side pressure on US dollar bond yields in the first quarter of the year. And we have seen bond yields over the past 3 weeks move a little bit higher. However, if we're looking sort of on a 12-month view, we do think that the US government bond yield will fall towards 3.25, potentially overshooting within the year at some point, as markets start to price in an economic recession and the resulting lower interest rates. So I guess that's why we sort of focused on bonds as being a good place to be investing. And if we do see any yield rebound, then we would be locking in these yields by extending bond maturity profiles within high quality government and corporate bonds, especially in Asia, actually. So if we look at the Asia US dollar bond universe, that's around 85% is US dollar. Is investment grade related. So high credit quality, very attractive yields, and some significant tailwinds coming through from the growth side, particularly in China, which is also a significant allocation within the Asian US dollar bond universe. So I think there's some good supportive factors, particularly in Asian US dollar bonds.
Got it. So just now, Steve, you mentioned about bond yields. So why are those high yields not supporting the US dollar?
Yeah, I guess this is the one thing that I'd say has surprised us this year. So our thesis was that in Q1 we'd see the Fed surprising on the upside in terms of rates, which we still expect, and we thought that would be supportive for the dollar. I think the main reason this hasn't happened so far, at least, is the surprise announcement by the Bank of Japan to widen its band for its yield curve control policy, which sparked a sharp decline in dollar yen. So while we'd flagged the Bank of Japan potentially making a policy change as a risk for 2023, obviously the shift became a lot earlier than anyone, including ourselves, expected. Looking forward, on a 12-month view, we're still bearish on the US dollar, right? So and that conviction, is, if anything, has grown over the past 3 weeks. So I guess the main question is whether we will see the dollar bounce in the interim, in the short term, over the next 2 or 3 months. I think we still do believe that will come to pass. So obviously, the Bank of Japan is unlikely to change monetary policy settings again. So I think the focus will shift back towards Fed policy. So we think the dollar will rally in the short term, but we would definitely be selling into those rallies on a longer term perspective.
Got it. So perhaps let's move on to equities. We're already getting some client questions on whether the sharp rally in China equity markets are an opportunity for investors to trim their positions. So just wondering, what are your thoughts here?
So I guess that another surprise over the past, we obviously had an inkling of this before we published, but the speed with which China has removed its COVID-19 restrictions has taken markets by surprise. Just probably a month ago, the expectation was that the only remove these restrictions gradually by around Q2 Q2 this year. So even before the easing of restrictions, we were already expecting consumption to add around 4 to 4.5 percentage points to GDP growth in 2023, and that's against just a 1% contribution in 2022. So we're already expecting that positive impact to come through. This estimate was most likely be higher now. Obviously, we think the GDP recovery has probably been brought forward by about 6 months. Now, we have to acknowledge, of course, that the surge in COVID-19 cases in mainland China could impact short-term growth. But the good news is we are starting to see signs of cases peaking in some of the cities, which I think suggests that markets should be able to look through this short-term growth hit as factories close and look forward to the strong recovery in the months ahead. As far as markets are concerned, the Hang Seng index's intraday break below key support at 19,380 earlier this week was met with very strong volume buying. So that volume was about twice the amount seen in the second half of December. So I think that's a pretty good indicator that sentiment still remains positive, and there's a good momentum behind Chinese stocks at the moment. Major resistance is around 22,200, so easy to remember, 22,200, where investors may look to lock in some profits. If we did break through there, obviously it would open up significant upside, but for now, that's our initial target.
Got it. So looking particularly into equity sectors, where do you see the biggest opportunities?
So I suppose following on from the China theme, we still see an opportunity to add to our China overweight sectors of communication services and consumer discretionary. Communication services in China is dominated by media and entertainment companies that, along with the consumer discretionary sector, should benefit from a rebound in Chinese consumption. An increase in new COVID-19 infections would obviously imply some uneven growth in economic activity, but over a 6 to 12 month time horizon, we think these two sectors should outperform amid economic reopening and increased signs of easing regulatory headwinds. Just one caveat outside of this, I think one of the sectors that we are overweight in Europe is the financial sector. This has performed incredibly strongly over the past month or so. I think, from what we're looking at the moment, saying that looks pretty stretched from a technical perspective. We look at our own proprietary diversity indicators, and that suggests the risks of a consolidation or maybe pullback in the financial sector is becoming more elevated. So therefore, we'd wait for a period of consolidation before considering adding further to financials in Europe.
Got it. Thank you so much, Steve, for such an inspiring market update and also some of our house views that you mentioned just now. So that's pretty much all we have for time for today. Thank you so much, listeners, for joining us today. And just a quick reminder, for those interested in joining us for a virtual investment outlook on Wednesday, please go to the link in the description of this podcast to register. In the meantime, wishing you all health, happiness, and prosperity in 2023.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.